The USA Crypto Summit, which many anticipated as a pivotal event for the cryptocurrency industry, has instead turned into a massive disappointment. Market participants, industry leaders, and investors alike were expecting groundbreaking announcements that would provide much-needed regulatory clarity, foster institutional adoption, and set a clear path for the future of digital assets in the United States. However, what transpired during and after the event was the exact opposite: confusion, market instability, and a series of policies that failed to address the core issues plaguing the industry. One of the biggest takeaways from the summit was the introduction of the so-called digital Fort Knox, an initiative spearheaded by the government to establish a strategic cryptocurrency reserve using seized digital assets. While the administration attempted to spin this as a move that would strengthen the country's position in the crypto space, market reactions painted a different picture. Investors had initially speculated that the government would allocate new funds to purchase Bitcoin and other digital assets, creating a strong bullish sentiment leading up to the summit. However, when it was revealed that the initiative would simply repurpose confiscated assets, many of which were obtained from illicit activities, the market reacted negatively. Bitcoin's price, which was hovering around $85,000 before the summit, saw a sharp decline of over 3% within 24 hours, signaling investor disappointment. Beyond the market's immediate reaction, the flaws in this strategy run deep. First, utilizing seized assets as a means of positioning the U.S. as a crypto leader does not address any of the fundamental issues currently affecting the industry. It does not create new liquidity, nor does it demonstrate a commitment to integrating digital assets into the financial system in a meaningful way. Instead, it raises concerns about government intervention in crypto markets and the possibility of these assets being dumped on the open market at a later date, further destabilizing prices. The summit also failed to provide clear regulatory guidance, something the crypto industry has been demanding for years. Figures such as Michael Saylor, CEO of MicroStrategy, and Brian Armstrong, CEO of Coinbase, were present at the event and have long advocated for a clear regulatory framework that fosters innovation, while protecting investors. Instead of delivering much-needed clarity, the summit only added to the confusion. Various policymakers provided contradictory statements on taxation, reporting requirements, and compliance measures, leaving businesses in a continued state of uncertainty. This regulatory ambiguity has already driven several crypto firms to move their operations offshore, where regulations are clearer and more accommodating. Countries like the UAE, Singapore, and Switzerland have successfully implemented balanced regulations that protect consumers while fostering industry growth. Meanwhile, the U.S. remains caught in a regulatory quagmire that discourages innovation and forces companies to operate in legal gray areas. Compounding the issues surrounding the summit is the recent catastrophic hack of Bybit, the world's second-largest cryptocurrency exchange. This security breach, which resulted in the loss of $1.5 billion, was reportedly orchestrated by North Korean hackers. The attack has sent shockwaves throughout the crypto space, raising serious concerns about the security infrastructure of major exchanges. Despite this alarming event occurring just days before the summit, there was little to no meaningful discussion about strengthening cybersecurity measures for digital asset platforms. The lack of urgency in addressing such threats only further highlights the government's disconnect from the realities of the industry. Moreover, the administration's inconsistent stance on crypto has contributed significantly to the market's ongoing volatility. Over the past year, we have witnessed a pattern of abrupt policy shifts, one moment appearing to embrace digital assets and the next implementing restrictive measures that stifle growth. This inconsistency has left investors and businesses with no clear direction, forcing them to make decisions based on speculation rather than sound policy guidance. One of the most glaring examples of this erratic approach is the treatment of stablecoins. While some government officials at the summit acknowledged their importance in financial innovation, others pushed for heavy-handed restrictions that could cripple their development. Stablecoins play a crucial role in crypto markets, providing a bridge between traditional finance and decentralized assets. Yet, instead of fostering an environment where they can be safely regulated and integrated, the government continues to send mixed signals, further exacerbating uncertainty. Adding to the market's woes is the broader economic landscape. Many analysts, including former BitMEX CEO Arthur Hayes, have been warning of a potential peak in the crypto market followed by a sharp decline. This forecast is now becoming a reality as the Federal Reserve's monetary policies continue to drain liquidity from the financial system. Rising interest rates, quantitative tightening, and looming tax deadlines have placed immense pressure on investors, leading to widespread sell-offs in both crypto and traditional markets. Another major issue that the summit failed to address is the ongoing banking crisis that has indirectly affected the crypto industry. Following the collapse of several regional banks last year, many financial institutions have become increasingly hesitant to work with crypto-related businesses. This lack of access to banking services has created additional hurdles for exchanges, blockchain startups, and even individual investors trying to enter the space. Despite the urgency of this problem, the summit offered no viable solutions to bridge the gap between traditional finance and the crypto sector. Retail investors, who once believed that mass adoption was imminent, are now beginning to lose faith in the market. The constant regulatory uncertainty, high-profile security breaches, and lack of institutional commitment have contributed to a bearish sentiment. As a result, trading volumes have plummeted, and many altcoins have seen their values erased overnight. While Bitcoin and Ethereum remain relatively stable compared to smaller projects, the broader market is experiencing one of its worst downturns in recent history. Even NFTs, which saw an explosive rise in popularity just a few years ago, are now struggling to maintain relevance. Many high-profile NFT projects have lost significant value, and trading activity has dropped dramatically. This decline can be attributed to both market conditions and a failure to develop real-world use cases beyond speculative trading. The summit did not offer any concrete plans to support the struggling NFT market, further reinforcing the perception that policymakers are out of touch with the realities of the crypto industry. Looking ahead, it is difficult to see a clear path forward unless significant changes are made. First and foremost, the government needs to establish a transparent and consistent regulatory framework that encourages responsible innovation. Businesses and investors should not have to navigate a minefield of unclear regulations and contradictory policies. A clear set of guidelines will provide stability and allow the industry to grow without fear of sudden crackdowns. Second, security must become a top priority. The Bybit hack should serve as a wake-up call that the crypto industry remains highly vulnerable to cyber threats. Exchanges and wallet providers must implement stricter security protocols, and governments should work collaboratively with industry leaders to develop global standards for digital asset protection. Without these measures, investor confidence will continue to erode. Third, there needs to be a serious effort to bridge the gap between traditional finance and crypto. Banks should be encouraged to work with legitimate crypto businesses rather than shutting them out entirely. Providing regulatory clarity on banking partnerships with crypto firms will help create a more seamless and integrated financial ecosystem. Finally, the government must stop sending mixed signals. If the US truly wants to be a leader in the crypto space, it needs to adopt a forward-thinking approach that balances innovation with regulation. Countries that have embraced blockchain technology are already reaping the benefits, while the US remains stuck in a cycle of indecision and half measures. The USA Crypto Summit was supposed to be a turning point, but instead, it has left the industry in a worse position than before. The market's sharp decline is a direct reflection of the lack of confidence in the policies presented at the event. If meaningful changes are not made soon, the US risks falling further behind in the global crypto race. And investors will continue to suffer the consequences of a mismanaged and misunderstood industry.